welcome everyone to our ongoing series of PPP webinars. My name is Adam Sweet. I'm a principal with iDaily. I'm part of our National Tax Office. I sit in Spokane, Washington, but more relevant for the next hour anyways, I'm also part of our SBA PPP working group. So happy to be here today and sharing kind of what we know so far on PPP round 2. And just a good resource, we always plug it, but I'll keep plugging it, but iDaily.com/PPP, it has, I think, most of our current insights. You'll also find links to past webinars, past articles, and so forth. So really encourage you to go there if you have maybe questions we don't address today, or basic questions, or questions back to PPP round 1, those types of things. Go to this website here, it may help you out. Oops. So today, our agenda today is PPP2. I'm going to use the terms PPP2 and PPP1. PPP2 is Paycheck Protection Program round 2. PPP1 is the first round that opened up back in March of last year. So our agenda today is second round loans and gross receipts, all things gross receipts. That's probably 50-60% of my presentation today, really. Secondly, updates on the first round PPP1. Third, how the first and second draw programs, first and second round programs overlap and work together. What are some of the similarities between those two? And then finally, if we have time, the Paycheck Protection Program and other code provisions, how they interact. And really, when I say other provisions, I should say other stimulus provisions that came out either in the spring of last year or at the end of 2020 as part of the Consolidated Appropriations Act of 2020, passed in the end of December. So with that, let's launch in. I mean, as always, we probably won't be able to get to questions, whether they're in the Q&A box or whether they're in the chat box. It tends to be too many. If we do have enough time at the end, I'll take a look. Or if I see some common questions pop up, I'll give it a go. But we may not get your question. And if that's the case, someone should be reaching out to you, hopefully afterwards, to follow up. So just as an introduction, PPP round 2, Paycheck Protection Program round 2 is now open to all borrowers, with the important assumption that your lender itself is accepting the second round applications. But opened up as of January 19th, 2021. So what, that was a little over a week ago. Round 1 has also reopened. Round 1 was closed since late last fall. So now round 2 and round 1 are open. Along with it, to keep everything fun and entertaining, the SBA has dropped a whole bunch of new guidance on us, including new application forms, both for the second draw, second round loan, which is this form 2483. And then also there's a revised first round application form, which is just 2483. I don't have links in here, but if you go to sba.gov, there are links there to all of the current PPP documents, guidance, and applications. And then we also have new forgiveness forms. Some of them mirror they've kind of just reorganized the prior forgiveness forms, so there's maybe nothing brand new. But then a couple of the forms are brand new, and we'll talk about that today as we go into it. So gross receipts. So to be eligible, this is for PPP second round specifically, but this is the general eligibility criteria to be eligible, not more than 300 employees. And then you need to demonstrate at least a 25% reduction in gross receipts during one of your 2020 quarters as compared to 2019, or comparing the whole of 20 to the whole of 19. And last time we talked in December, our big point was we didn't know how gross receipts will be defined. It wasn't defined in the statute. We didn't know whether that would be a tax concept, a financial accounting concept, some hybridization of the two. We do now know what it is. Amy, there's a little delay. I don't know why, but when I go slide to slide, a little delay. But we now have guidance, and what they being the government, very expansively define gross receipts. And this is a little snippet of it here from the guidance, so that it's revenue from whatever form, received or accrued, including from the sale of products, operating income, interest, dividends, rents, royalties, fees, commissions, all these different things. So it's very expansively defined. A key on those two terms there, received or accrued. That's kind of, we're back to the first round of PPP when we have tax basis concepts, cash basis concepts, which is received, and accrued, which is maybe more financial accounting. We'll circle back to that in a second. But maybe what to take from this slide is a very expansive definition of gross receipts for PPP2 purposes. What do gross receipts not include? It's almost, you can almost define it by exclusion in a way. You could almost say gross receipts are everything but what's excluded. Here are a couple of categories of things that are not included, taxes and so forth. This second bullet point that I've bolded is a big item. It's proceeds from transactions between a concern and its domestic or foreign affiliates. And we'll cover affiliates as well here in a couple of slides. But affiliates generally are businesses that are under common control or common governance. So intercompany transactions, and I use that term broadly, those amounts are not included in gross receipts. So some of the examples I immediately think about are, and that we've actually seen in practice, are management fees. If you have a company and you pay a management fee to a management company, if the management company and the operating company are both affiliates, the fees paid to the management company are apparently not included as gross receipts for PPP2 because it's a transaction between a concern and an affiliate. Same thing for related party interest. If there's related party debt, return on equity, potentially. And no doubt there's many other examples. Any type of intercompany revenue source, if it's between two businesses that are deemed to be affiliates for PPP purposes, affiliation is not a tax concept. It is a tax concept outside of PPP, but specific to PPP, when we use the word affiliation, it's not a tax concept, it's a PPP concept. Then these intercompany items are ignored. And then, down below, just again, reminding us that all other items, basically, if it's not specifically excluded, it's included in gross receipts. And I would just say most of the examples you're going to be thinking about in your head, the answer is yes, they're gross receipts. So if you can't look to the guidance or look to the slide and see a specific exclusion, probably the item you're thinking about is gross receipts. Gross receipts do not include forgiven first round PPP loan proceeds. So in a way that's good, because if that was part of your 2020 gross revenue, it would be harder to show a reduction as compared to 19 if your PPP first round proceeds were included into gross receipts when forgiven. Also, any idle advances, which were up to that $10,000 emergency grant that you could receive, also not part of gross receipts. And if you are thinking about other items of COVID relief and trying to figure out whether they are considered gross receipts or not, I think the key phrase here is, if the item is not subject to federal income tax, it's not included in the calculation of gross receipts. If it is subject to federal income tax, it apparently is included in the calculation of gross receipts. So for instance, provider relief funds, which were given to lots of healthcare entities kind of through the Medicare Medicaid system, those are taxable proceeds. And so those items, it appears, represent gross receipts for those borrowers. So that could be a big issue if you're a medical practice, if your revenue was down for 20, but these provider relief funds were deposited into your account through the Medicare Medicaid system, and that increased your gross receipts. Presumably those provider relief funds are part of your gross receipts base for 2020 and may not help you all that much when you're trying to show a decline to 2019. Also excluded, we see this from time to time too, outside of the PPP, traditional SBA loans. There was a deferral, originally I think it was 5 months, I think it may be, can't remember, maybe up to 11 months, where the government, first there's deferral and they were paying the interest, and now I think they've basically paid principal and interest during that time. Again, those amounts are excluded from gross receipts because they're not taxable. The legislation passed at the end of December said that these SBA loan payments made by the government are not taxable. But again, everything else, If it's taxable, and that even includes state relief, I know different states have different programs where they may be providing aid. If that's taxable to you, then I think it's in your gross receipts bucket for PPP2 purposes. So some other quirks here. So I mentioned affiliates, which is a PPP concept here. If you're a business and you have affiliates, you include your affiliates' gross receipts in your test. And this first bullet is a direct quote from recent governmental guidance that gross receipts of a borrower's affiliates are calculated by adding the gross receipts of the business concerned with the gross receipts of each affiliate. So it sure seems to be what the net result here is that gross receipts are tested at an affiliated group level. And generally, every affiliate member then, I guess, will have the same gross receipts because it's all one bucket. So if you have 5 different affiliated companies, some had plus revenue for 20, some had minus revenue for 20. It doesn't seem to matter. You're going to group those all together. You're going to combine that for 20, then you're going to compare it to 19. If you have the relevant drop in gross revenue, apparently every single business would qualify as long as you meet all the other eligibility criteria. And if you don't qualify, meaning your gross receipts were too high for 20 in the affiliated basis, then it would kick out every member of that affiliated group, even if individually each affiliate member or one of those affiliate members could have qualified. So kind of a strange result. I'd also just say, don't forget gross receipts for a second, but remember also that the 300 employee test is also tested at an affiliate level. So not only are you grouping gross receipts together, but also when you test for number of employees, you include all affiliate employees. That was the same for PPP1 when we tested for 500 employees, and certainly the case for PPP2 when we test for 300. Now, the big exception to these affiliation rules are NAICS Code 72 businesses, restaurants, hotels, people involved in the hospitality industry, listed franchises that are listed in the SBA's franchise directory. If this is your business, or if you're advising this business, they generally then are tested on their own, both for gross receipts and then for employees. So if affiliate gross receipts are not included if you are an accepted entity. And then, of course, here too, yes, we're testing on the affiliated group level, but again, any intercompany items would be excluded. So if we're non-exempted entities, so we just have 5 businesses that are not NAICS 72, not listed franchises, if they're affiliates, we're going to test them all together, but intercompany items we're going to exclude. So management fees, related party interest, and so forth, still excluded. So what is an affiliate? So when we say affiliates, and we obviously know affiliation is important to test gross receipts and employees, the SBA generally defines affiliates very broadly. And if you Google, I'm not going to go into enough detail here today to really satisfy lots of people's questions. But if you just Google PPP and affiliation, there's a notice that was put out by the SBA in April that highlights 4 different ways that you could become an affiliate. And those ways, basically, 1, are based on common ownership. 2, if there's kind of common stock options, convertible securities, agreements to merge, etc. 3, affiliation based on management. And 4, affiliation based on identity of interest. The affiliation based on ownership, generally speaking, looks to 50% or more than 50% common ownership, which is fairly straightforward. That's also traditionally how we determine related parties for tax purposes. More problematic sometimes for people, problematic meaning where affiliation arises where people don't expect it, is when there's common management and then also common identity of interest. So you could have, let's say, a group of directors that can make management decisions for 2 different businesses. Potentially, if it's the same directors for each business, those businesses could be determined to be affiliates, even if there isn't more than 50% common ownership. So in my experience anyways, when we have businesses that have more than 50% common ownership, everyone already expects them to be affiliation. It's these last couple, particularly affiliation based on management, where people are surprised to learn that a couple of different businesses are grouped together and treated as affiliates for PPP purposes, for SBA purposes. So if this is raising lots of questions, I just Google SBA PPP affiliation. There's like a nice 2 or 3 page document from the SBA that outlines these tests in more detail with examples. But just don't forget now, as you're preparing your PPP2 application, that you need to take into account your affiliates, both for gross receipts and for testing number of employees. We've also seen from time to time that borrowers in the first round perhaps didn't take into account affiliation when they applied. And this is coming up now on the forgiveness side of things. And I have a slide a little bit later in the deck to kind of cover that. But it could rear its ugly head not only for the second round, it could also rear its, quote unquote, ugly head for when you're seeking forgiveness of your first round loan, and suddenly there's an affiliation issue there that maybe not everyone appreciated back in March and April. So here's an example I put together. I think it makes sense. I'm an attorney by training, an attorney by practice, not a CPA. So when I start putting numbers on a slide, danger, danger, danger signs should be everywhere. But I think everything is right here and balances out. And what we have here are 3 different companies that we're going to call them all affiliates based on previous SBA guidance. We have an NAICS 72 company on the left, which we know is exempted. We have a non-waiver company on the right. And what I mean by non-waiver is it's not a dealership, it's not a listed franchise, it's not a NAICS 72. Then we have a management company. And what I think this slide shows is if you go around the circle, the NAICS 72 company is tested on its own for gross revenue. So on its return at $100 of gross receipts, that is its gross revenue for PPP purposes, because it doesn't have to take into account the affiliate rules. Also, NAICS 72 Co, its number of employees for PPP is just its actual number of employees. If we work our way over to non-waiver Co on the right, again, it has $100 of gross receipts from unrelated parties. For PPP2, it's going to be deemed to have $200 of gross receipts. The NAICS 72 company, which is non-waiver Co's affiliate, NAICS code 72 company's gross receipts are included for non-waiver Co. Even though NAICS 72 stands on its own for its own purposes, for non-waiver Co's purposes, it's grouped together. Management company, which derives all its revenue from management fees. Well, we know from SBA guidance, intercompany items between affiliates don't constitute gross receipts. So management company on its own has no gross receipts, but its 2 affiliates, which are NAICS code 72 and non-waiver code down below, those 2 affiliates, their gross receipts are included for management company. So look at that slide. I know that sounds confusing. I think if you kind of look through that slide, I think I put enough there maybe to link through it. I think what it illustrates there are a couple of things. Intercompany items are ignored. 2, if you're an exempted entity, if you're an NAICS 72 entity, a listed franchise, etc., you test gross receipts on your own. For all other businesses, you include affiliate gross receipts, including if your affiliate is by itself an exempted entity. And again, this is not only for gross receipts, but this is also for number of employees. A couple other nuances to the affiliate rule. There's a rule, and we're still thinking our way through this over the last week or two, and I think I understand how this rule works, but you'll see where the confusion could arise. So from time to time, what we have is someone that acquired an affiliate in 20. So they didn't own the affiliate in 19, they have owned the affiliate in 20. And so the logical question is, well, what do I do there? Because I don't have gross receipts from 19. I didn't own the affiliate then, I owned it in 20. And what the SBA says, if you acquired an affiliate in 20, you use the affiliate's gross receipts both for 20 and for 19, even though 19 was a year before you even owned the affiliate, you include its gross receipts there for purposes of PPP2 of comparing 20 to 19. I think what they're trying to do here is get an apples to apples comparison. Otherwise it would be, if you acquired an affiliate in 20, it'd be very difficult, especially if it was a material acquisition, it'd be very difficult to show a gross receipts diminution in 20 as compared to 19. So they're saying, okay, well, you can bring the gross receipts from the affiliate in 19 pre-acquisition to it. Notice one offshoot here is, well, what if you started up a brand new affiliate? So you didn't acquire it, but if you just started up a brand new affiliate in 20, the affiliate didn't exist in 19. I guess there are no receipts in 19 to use. And so again, if that was a material startup, those gross receipts added to your other affiliates gross receipts for 20, it may be very difficult or impossible even to show a gross receipts diminution as compared to 19. But the other strange quirk here is, and again, when I put quotations around, this is direct quotes from the SBA, is the SBA says if you acquired a segregable division of another business during 20, you don't include the gross receipts pre-acquisition. So the logical question there is, what's the difference between an affiliate and a segregable division? Because there's very different treatment. And to be honest with you, I don't quite understand it. We don't know whether a segregable division is some smaller component, whether an affiliate is a going concern versus a segregable division is some slice of a going concern. I don't know. And it's always hard because they throw out these terms. They don't define the terms necessarily. Maybe you could look to other areas to see how segregable division is defined, but it's difficult. Now, I don't have an answer for this yet. If someone else does, I'd be happy to hear it. But clearly two different treatments depending on if you acquired an affiliate versus a segregable division. If you said, Adam, what's the difference between those two? I would put my hands in the air and said, not quite sure at this time. So then we continue on. So we've done gross receipts and affiliates. So then the next thing is, okay, well, so we've added up our gross receipts to the best of our ability. We've determined who's an affiliate, who's not. We've figured out whether we acquired an affiliate in 20 or a segregable division. Anyways, we've computed our gross receipts for 20. We've computed it for 19. How do we do the math? And what you do is you can choose, generally speaking, a calendar quarter in 20, and then compare it to the same calendar quarter in 19. Alternatively, if you were in business for the whole of 19, you can compare the whole of 20 to the whole of 19. And you can choose which one of these you want to do. And obviously, there's going to be people out there that had really good 2020 tax years that maybe may not be able to show 2020 25% decline, but they may be able to choose a particular quarter in 20. So there's going to be some gamesmanship here, and I think that's fair game that they've given us these different ways to do it. You don't have to use one or the other. They just said the any quarter in 20 as compared to 19 is from the statute, and then the SBA just said to make it administratively easier, we're also going to let you compare the whole of 20 to the whole of 19. Clearly, it needs to be a calendar quarter. So you can't choose just any 3 months in 20. You can't choose May, June, July. You need to be using the first three, second three, first, second, third, fourth quarter of 20 as compared to the same quarter in 19. It isn't totally clear in the statute, but SBA guidance has made that clear. And then I saw some SBA communication over the weekend that again reiterated to lenders that you must use calendar quarter. You can't just cherry pick any 3 months you want to use. Also, it appears that there is no way to use a partial quarter or prorate. This comes up, what if you just started up in a particular quarter so you didn't have a full quarter of revenue? It appears you still just have to use whatever revenue you had from that quarter. You can't prorate it out over the full 3 months, or you can't suddenly just go to the next quarter and start new there for the first full quarter. So kind of a quirk. I haven't seen anything yet that smooths that out. And we have seen this come up. I've seen this come up in practice a few times, that you get kind of a strange answer because a business started up in a particular quarter, so you don't have a full quarter worth of revenue. It seems like you're just stuck with what you have. And of course, as always, we have all these special rules where, if you notice my previous slide, basically just assume that you're in business for all of 19 and all of 20. We have special rules where if you weren't in business for the whole of 19 or the whole of or if you weren't in business for the whole of 19, what do you do? The first bullet here is if you weren't in business for the first couple of quarters of 19, but were for the third and fourth, what do you do? Same thing for the second and the third. The one thing I would say is categorically, full stop, end answer, you had to be in business as of February 15th, 2020 to be eligible for a PPP2 loan. So, and I think practically what it means, even if you had to have payroll as of that date. So there's room to play, or arguments to be made if you started up in 19. You know, there's arguments to be made if you started up in January of 20. If you started up after February 15th of 2020, the rules are clear. You are not eligible for a PPP2 loan. So how do you prove gross receipts? Well, what the SBA says is you could do it any number of ways. I mean, one, you can use financial statements, quarterly financial statements. If they're not audited, then you must sign it and date it, basically certifying that they're correct. If you don't have quarterly financial statements, you could use quarterly or monthly bank statements for the borrower, for the business entity, showing deposits for the relevant quarters. The SBA makes it clear here that if you use bank statements, that's a little messier. And so you're going to have to make it clear when you're submitting a monthly statement, you know, what items are gross receipts versus what items aren't gross receipts. So the SBA uses the example of a capital infusion. So if an owner puts 100 grand into a business, that's not gross receipts, that's capital. Similar, I think, for intercompany items, like I mentioned before, management fees and so forth, items that we know don't represent gross receipts. They're going to show up in a bank statement, but you're going to have to indicate to the SBA what numbers are gross receipts, what numbers are not. And then you can also use tax returns. So they call annual IRS income tax filings. I don't know why they don't just say tax returns, because that's what an annual IRS income tax filing is. And interestingly here, and this is going to be true for most people, in fact, I'm not aware of any business yet that's filed its 2020 tax return. Filing season doesn't open up for another couple of weeks. So in a way, you're going to be filling out a tax return that has not yet been filed with the IRS, submitting it to the IRS, or submitting it to the SBA and your lender for PPP2 purposes. But you have to promise that the values that you put into the gross receipts computation for your PPP2 loan are the same values that will be filed on the entity's tax return. And as you think through that, that could be challenging, because undoubtedly you're going to be working pretty quickly. If you're applying for PPP2, if your year-end financials just closed and you're trying to add up the numbers and so forth, and you're trying to come to an answer, if you're going to be held to that answer for tax filing purposes, you can see potential issues there, that maybe someone's going to overstate accidentally, right, unintentionally, overstate gross revenue for PPP2 purposes, come to a number that's a bit larger, and then they're going to come to the summertime and get ready to file their tax return and realize, well, wait a minute, the gross revenue number we put on our PPP2 application is not the gross revenue number that we're coming to for tax return purposes. If that's you, and then you put a different number on your final tax return, it sure seems like you violated this certification that, you know, you're required to attest that the values you put on the PPP2 application are the same values you put on the tax return. It just seems that that's setting up the stage for lots of problems as these months go on. I guess you could wait. In PPP2, I think you can apply for PPP2 up until end of March, I think. Don't quote me on that. So I suppose you could wait. If this is you and you're worried about this, you could wait to apply for PPP2 until your tax returns are close to finished. That way, you know, and that's if you're going to rely on your tax returns. That way, you know that the numbers you're putting for PPP2 application purposes, gross revenue numbers, will match your tax return. But then again, too, you don't have to use your tax return. You can use financial statements, you could use bank statements, other things. So you'll notice the couple 6, 7, 8 slides ago that when I highlighted the definition of gross receipts, the statute itself from Congress or sorry, the guidance from the SBA uses the term revenue in whatever form received or accrued in accordance with the entity's accounting method. And it doesn't say tax accounting method, it doesn't say financial accounting method. So my interpretation of this is if you're a cash basis taxpayer, but you accrue your financials, you could use either concept to demonstrate gross receipts. Now, obviously, if you use cash basis, if you're a cash basis taxpayer and you're using cash basis method to compute gross receipts, then the proof of that's going to be your tax returns. You're not going to be able to use the cash basis to compute gross receipts and then submit accrued financials. That would kind of apples to oranges. But within that, if you're cash basis taxpayer, you could go that route with your tax return. Or if you have accrued financials, you could go that route and use your financials as documentation. And again, I think there's room here for a bit of gamesmanship that maybe on a cash basis level, you didn't have the gross receipts diminution, but on an accrual basis, on a financial reporting perspective, you did. And I think the SBA is blessing that. That's fine. You can use whichever method potentially puts you in a better spot. Just need to be consistent with the documentation you provide, and then obviously be consistent with comparing 20 to 19. You can't use cash basis for 20 and an accrual concept for 19 or vice versa. Here is, this is directly from the government, that if you are using tax returns to demonstrate gross receipts, these are specific line items from your tax filing along with the associated schedules. So I won't spend too much time here, but you can look through this list. If you're an S corporation, C corporation, partnership, et cetera. This, and I didn't create this list, I just copied and pasted it right from the SBA. This tells you exactly where to go. If you're still confused about the definition of gross receipts and you're like, well, I want certainty, well, you can use your tax filings, and the government right here is telling you where to go on your tax filings to find the gross receipts figure. When do you have to submit your gross receipts documentation for PPP2? If your second draw loan is up to $150,000, and we're going to come back to this $150,000 number, so we'll stay focused on that, but up to $150,000, you're going to provide your gross receipts documentation at the time you seek forgiveness. And the documentation is going to be, again, showing your 25% reduction, right, for the whole of 20 as compared to 19, or for a particular quarter in 20 as compared to that same quarter in 19, or if you started up in 19 following the special rules. For loans above 150 grand, the documentation must be provided at the time of the application. So again, it's going to be easier if you're borrowing 150 grand or under. You can maybe punt if you know you had a 25% reduction, but you don't have it exact. You can apply now and just know that you only have to prove it out with actual figures at the time you seek forgiveness. Versus if you're above 150 grand, you're going to have to do the work right now. And I just hit this point because we've had clients ask this exact point. Given that you could use cash basis or accrual, given that you can compare all of 20 to all of 19, or that you can pick a particular quarter in 20 and compare it to a particular quarter in 19 to show this more than 25% reduction to gross receipts, there are going to be more than a few borrowers out there who can satisfy the gross receipts reduction test in 20, even though the whole of 2020 was a good year. In fact, even though the whole of 2020 undoubtedly was a growth year, where they may have their gross receipts grew in 20 as compared to 19, but maybe they can go back to the second quarter of 20, which would have been, right around all the different states were shutting everything down, and they're going to at least be able to show that second quarter was a 25% reduction. And the question back to us as the advisors, and the question in the client's mind is, well, what do I do there? If technically, if I have under 300 employees, and if I technically satisfy the gross receipts test, do I just apply for the PPP2 loan? I mean, is there some risk there that when I seek forgiveness, the government's going to deny it because they're going to say I had too good of a year in 20? unclear. I think the one thing that we all need to remember is the certification that everyone needs to make on their PPP application. This was both for the first round and the second round, is that current economic uncertainty makes this loan request necessary to support the ongoing operations of the applicant. And this certification is what gave rise to the Form 3509 and the Form 3510 for borrowers who borrowed in excess of $2 million into the first round of the PPP-1 program. So the 3509 and 3510 are these pages and pages of intrusive questions about cash on hand, owner equity, access to other sources of liquidity. None of these questions existed when people applied for PPP-1 back in March and April of 20. Questions popped up afterwards. The basis or the justification the government's given us for these forms is this certification. So I think that's that's the other hump you have to get over, that if you've had a really good 20 and technically you satisfy the gross receipts test, think about this other certification, that can you make that certification? Are we going to have further surprises from the government about similar to the 3509 and 3510? I don't think so. I think it would be particularly bad faith at this point. You know, the 3509 and 3510, maybe one argument the government could make was that that first round rolled out so quickly that they didn't have time to prepare it. You know, now they've had 10 or 11 months. I think it'd be really bad practice for the government to come up with a similar form for PPP2, but they could. So that's the only warning I would give if someone put me on the spot to ask what I thought about someone who had a great 20 but could still satisfy the gross receipts reduction test. So now let's transition a bit to PPP1. So this is the first round that opened up back in March of 20, closed back in the fall, and is now reopened again. So as part of the year-end legislation, certain farmers and ranchers can now use gross receipts as a surrogate for payroll. So self-employed people could always use net earnings as a surrogate for payroll. So this would be partners, Schedule C filers, and so forth. But if you had a net loss, then you weren't eligible originally. If you had a net loss with no employees, you didn't have any payroll and you weren't eligible. So now if you're a farmer and rancher, you can use gross receipts as a surrogate for payroll. I just remind you there that you have to start with the first draw loan, because you can only be eligible for a second draw loan if you've taken a first draw loan and spent all the money. So if you're newly eligible, you need to go back to PPP1. Also, the SBA instructions talk about a Form 1040 Schedule F filer when they talk about farmers and ranchers. So apparently this means only farmers and ranchers that report their activities on their own returns. It appears farm partnerships, other types of farm entities can't use this special rule for gross receipts. It looks like it's only individual farmers and ranchers who report their farming and ranching activities on their personal tax return. Also, some borrowers have discovered, and really we've discovered alongside some of our clients, that they could have borrowed more under the first draw program. Why would they now just discover that? Well, there was a lot of guidance that came out in the summertime as to the definition of payroll. If you think back to the first draw PPP program and the second draw for that matter, to determine your loan amount, it's based on your payroll, 2.5 months of payroll. And so there are all these questions about what is payroll. And one example is originally it was not clear if you're a partner in a partnership and you get a K1, are partner earnings, guaranteed payment, or self-employment earnings, are those payroll of the partnership? Are they payroll of the partner? Are they just not payroll period? And there are no doubt some early borrowers who applied and didn't include partner self-employment earnings as payroll at the partnership level. And I think it was in April or May that the SBA said, in fact, partner earnings are considered payroll of a partnership. So that's just one example of a partnership could have shortchanged itself. So what the SBA now has said is there are ways, if this is you, if you undercounted payroll, and if you were entitled to more PPP1 proceeds, there are ways to increase your PPP1 loan. I use the term right size your PPP loan. You know, you undercounted it before. there's ways to right size it. Key point here is if you've already applied for forgiveness of your PPP-1 loan and then the SBA has remitted payment on that to the lender, you cannot right size your loan. Even if you undercounted, even if you undercounted by a bunch, if you've already gotten forgiveness and it's been remitted to your lender, then you cannot right size. So how do you do this if you think that you undercounted your first draw loan? Say, go back to your advisor first of all and figure out what was done and if in fact you can right size your loan. But the way you do it, if you are eligible, is you work directly with your existing lender. So the person that gave you the first round loan, you go back to them to work with it and right size it. There isn't a separate application form. The lender then works through the SBA's E-Trans servicing site, which that's the site that lenders interact with the SBA through. So it's really actually a lender job to do. There isn't a form that I'm aware of. There's no official SBA form that you submit to your lender asking to right size your loan. Maybe individual lenders will come out with their own version of a form. But for starters, if you think you're affected by this and you want to right size your loan, I go right to your lender right now and say, hey, I was entitled to X amount of dollars more. I want you to go to the SBA and right size my loan and see what the lender says. And then finally, I just say though that no matter what, your first draw loan cannot exceed $10 million and it can't exceed more than $20 million for a corporate group. So you can't right size your loan beyond the limits that have always applied to PPP-1. So with the good comes the bad. No doubt, while there are some people that didn't borrow as much as they were able, there are going to be other people that found out they borrowed too much, whether it was a lender error or whether it was a borrower error. And what the SBA reiterates here is no matter who made the error, doesn't matter if it was the bank, doesn't matter if it was the borrower, there is no forgiveness for that amount. And this is unfortunately coming up from time to time with our clients that, again, the program was moving very fast back in March and April, and people in very good faith submitted applications that maybe there was a mistake there. Maybe the bank even made the mistake. Unfortunately, the liability is ultimately with the borrower, not the bank here, if there was too much borrowed. So you can't get forgiveness on it, and really you're going to have to return those proceeds. And notice too, it's an error made in good faith. I mean, if it was fraud, then you're potentially facing worse consequences than just having to repay the loan. But we haven't seen that. The errors we've seen in practice are, again, people just the chaos of COVID-19 March and April, and then the chaos of the PPP round 1 opening up, people submitting their application through, banks not quite sure what they're doing, borrowers kind of figuring out the rules as they go, and it turns out you borrowed more money than you should have. And it's probably going to come up on the backside as you calculate your forgiveness amount. If this is you, then you're going to have to return those proceeds. The form 3508S, this is a forgiveness form. It was originally created for loans up to $50,000, PPP-1 loans and now PPP-2 loans. And it was a simplified forgiveness form where you just had to make a couple of quick certifications and your loan could be forgiven. This 3508OS form has now been expanded for loans up to $150,000. Why? Well, it reflects now the legislation passed at the end of December said for loans up to 150 grand, there shall be a one-page forgiveness, simplified forgiveness form. So the government adopted this 3508S to meet this form. If you're eligible to use this form, meaning your loan's up to 150 grand and you don't have any affiliate loans, I'm going to cover a couple of these points in the next slide, and you've already submitted your forgiveness application, you can resubmit using the 3508S as long as the SBA has not reached a decision on your forgiveness form. I don't know why you would do this necessarily. If you're expecting full forgiveness anyways on the document that you've already submitted, I wouldn't suggest that you pull that back. But at the same time, if you submitted a forgiveness form that had a bunch of complicated calculations on it, maybe you're worried that you made a mistake, maybe you're worried that the bank's going to focus on something they shouldn't, you could bring that other form back and resubmit using the 3508S. And this is just, again, this is the one-page forgiveness form that was promised by Congress. You don't have to do your on the form itself, you don't have to do the FTE calculation, you don't have to do the salary reduction calculation, just several certifications. This is the language directly from the SBA I've quoted here. And I'm going to show you here, like everything the SBA does, it's never quite that clear, but here's really this is directly from the 3508S. These are the two certifications you need to make. You notice here, there's no numbers. You don't have to list employees. You don't have to list payroll and all that. It's basically have to say that you got the loan in good faith and used a loan for its intended purposes. But here's kind of the very strange cautions that they've given us. Even though the 3508S is now for loans up to 150 grand, they say that if you borrowed between 50 and 150, you still have to take into account FTE reductions and employee salary and wage reductions. It's strange because you don't actually do that in the 3508S. Apparently it's, the joke I heard this morning was you'd be doing it on your desk at work or in your, your scratch piece of paper. I guess that's where you're going to do it. So, and then you would have to reduce your forgiveness amount by that amount. Same thing if you had a $50,000 loan, but if you have affiliate loans and they all add up to more than $2 million. So it's a little bit strange there that it's truly a simplified form only for borrowers up to 50 grand. Between 50 and 150, you're supposed to make sure that you didn't reduce FTEs, you didn't reduce salaries by more than what you were allowed to do, let's say. And if you did, then you would reduce your forgiveness reported on that 3508S. I'm probably not explaining this as succinctly as I could, but read the instructions on the 3508S. It's a bit confusing and a bit muddy. And in fact, it may just be easier in certain circumstances, it may be easier to use the easy application. Even if you're eligible to use the 3508S, if you use the easy application, you may be able to say, yeah, I had an FTE reduction, but I'm going to check the box that I met the safe harbor and be done with it. And that may turn out ultimately to be an easier form than this 3508S. SBA review, this is for PPP1, but also this will be eventually PPP or PPP2. Just a reminder that the SBA at any point is free to review a loan, and they could focus on original eligibility. They could focus on how the proceeds were used. They could focus on your forgiveness application, really anything they want. For the most part, the SBA attention we've seen has been after a forgiveness form has been filed, and then the 3509 is given to the borrower through the lender. We have seen it once or twice, actually, even pre-forgiveness, where a borrower is notified that their loan's being reviewed. So I just say this can happen. This can happen. But what is the process? Well, this third bullet and then the 4 sub-bullets underneath it are what the government now tells us, that the SBA first notifies the lender that a loan's being looked at, and then the lender must notify the borrower in writing within 5 days of any of the following. And it's a decision to deny forgiveness, a decision by the SBA to decline in whole or in part forgiveness, a review, or if there's been remittances paid by the SBA to the lender. So practically speaking, if your loan is looked at by the SBA for whatever reason, you're going to hear about it through your lender at first. No doubt at some point, as things move farther along, you may have direct interaction with the SBA if your loan's being reviewed. But for starters, you're going to hear about it through your lender. And then finally, if your PPP loan is being looked at for whatever reason, and this could be because you've submitted the 3509 or the 3510, that could hold up your PPP2 loan. The government said that. So if they're reviewing or auditing your PPP loan for whatever, PPP1 loan for whatever reason, and you submit a PPP2 loan application, that could get held up until the SBA's review of your first round loan is solved. So like always, we're running a bit out of time here, but just kind of at the end, I wanted to cover maybe some of the interesting ways that the first round and the second round programs interact. And the first thing is, to be eligible for PPP2 loan, you have to certify that you received a first draw PPP loan, and that before your PPP2 application, you will have used the full amount of the loan on eligible expenses. You don't have to submit your forgiveness application yet. It just says you need to use all your first round monies. It doesn't say that you had to use all those monies during your covered period. So what that means, we think, is you could even have a PPP1 loan that you don't expect to achieve full forgiveness. Let's say that you only, you borrowed $100, you incurred $80 of eligible expenses during your covered period. So 80% of your loan's forgiven, and then the remaining $20 outside of your covered period, you used in eligible expenses, payroll, overhead, qualified overhead, and so forth. I think you're still eligible then for a PPP2 loan, even though not all of the qualified expenditures generated forgiveness. Kind of another, I won't say interesting, but another overlap between the two is the second draw loan, the amount. So when you go in to calculate your loan, generally it's 2.5 months of payroll. If you're an NACS 72 business, it could be 3.5 months of payroll. But you have to determine your average monthly payroll, and you can use 2019, 2020, or rolling 12 months. And you're clearly going to have overlap. Some borrowers clearly are going to have overlapping pay periods here between PPP1 and PPP2, meaning that PPP1 proceeds funded a pay period that would also be generating a loan amount for PPP2. I think this is just fine. I think it's just the way the rules work. I'm not sure how else the SBA would do it, but we have had that question come up that somehow, because you used PPP1 proceeds on payroll, does that mean somehow that you can't use that payroll for PPP2 purposes? My answer is no, not an issue, I don't think, and unless the SBA surprises us tomorrow with another interim final rule. You need, when you're applying for your PPP2 loan, you need a first draw SBA loan number. And I've just highlighted here, this is the application for PPP2. I put there in the bottom with the red arrow. Probably not a problem. If you're using the same lender for PPP2 as PPP1, that lender should have your SBA loan number. If you're using a different lender, I've heard of a few people that actually have struggled to find their first round loan number. So maybe that's some of the diligence you want to be doing up front as you're getting your application ready for PPP2. Make sure you have your first round loan number. The SBA is requiring that to demonstrate that you got the first round loan, because that's one of the eligibility criteria to be eligible for the second round. You can apply for PPP2 even if your PPP1 loan is not forgiven. We've heard of lenders telling people that you actually have to submit your PPP1 loan forgiveness application before you apply for PPP2. That is not true. You need to use your PPP1 proceeds by the time you apply, but you don't need to apply for forgiveness for your first round. However, when it comes time to submit your forgiveness application for your second round loan, you may need to submit your first round loan application first. And this is for loans in excess of 150 grand. That would be your ordering. But again, that's down the road. That's when you're seeking forgiveness of your PPP2 round loan. Why would a lender say that you need to submit your forgiveness application before applying for your second round loan? I think some banks just want to be done with this. And so they're pushing borrowers to apply for forgiveness. And so the banks can be done with it. You're certainly free to submit your forgiveness application, but don't feel like you have to. FTE reductions, this is our old friend, full-time equivalency. If you don't maintain your full-time equivalency counts, and then also if you don't, if you cut salary for certain employees in excess of 25%, there were all these rules under the first round where you use a reference period and then you compare that to your covered period. I would just say the same reference periods apply for both PPP1 and PPP2. Additionally, the safe harbor dates under PPP1, there was dates to restore FTE cuts or restore salary reductions. And if you did it by that date, you wouldn't be penalized. For loans before 12/27/2020, that safe harbor date is 12/31/2020. For loans made on or after 12/27, so this would be every second round loan, that new safe harbor date is the last day of your PPP2 loans covered period. Same for salary reduction. Again, if you're trying to find your safe harbor date to restore cuts, it's going to be the last day of your covered period. Remember, for PPP2, you're free to choose a covered period between 8 and 24 weeks. So you can make it a 10-week, a 12-week, a 14-week, so forth. And that last day of whatever covered period you choose, that will be your new safe harbor date to restore FTE and restore salary reductions. This is a interesting quirk that we've talked about amongst our national tax group. I've talked about it kind of in depth actually with our DC office. But the CARES Act, which was the act passed in March of 2020 that created the first round of the PPP, said basically that if you're going to use PPP payroll, cannot also be payroll that generates what's called a family first credit. What's fair enough. And I think our advice at the time was that you can't double count. If you're using something as payroll for PPP purposes, you generally can't double count that for other purposes. That was certainly true originally for the employee retention credit. Now that's changed a little bit. You can use the ERC in conjunction with the PPP, but you can't double count the same payroll for both. But specifically to the FFCRA, it just said that you had to make an election not to have that credit apply. So it almost seemed to say that if you wanted to use your payroll for PPP purposes, you'd have to elect out of this family first credit. Now, of course, no one did, because there's no way to even make that election that we know about. But our question is, by just not claiming the family first credit, is that kind of a de facto election to use the payroll cost for PPP purposes? And then maybe conversely, if you wanted to go back and claim the family's first credit, what does this do to your PPP loan? Does it, have you somehow overstated your loan because the payroll that you included is 2.5 months of payroll for your PPP1 loan balance? Is that now no longer qualified payroll? We don't know. I don't think this is going to be a huge issue, but it is an interesting, as you trace the statutory language, we're going to need some guidance from the government here on how this works. I'm going to guess what they're going to say is, if you took a PPP loan, you automatically elected out of this family's first credit. But something to watch there. And then finally, on the ERC, employee retention credit, the Paycheck Protection Program and the Employee Retention Credit are no longer mutually exclusive, meaning you can claim both, but you can't double count payroll as both an eligible expenditure for PPP and also for the ERC. We still don't have guidance on how these two sections are going to interact with each other, so I just say stay tuned for that. Hopefully we're going to see something from the IRS here in the next couple of weeks that will help clients figure out how they can compute their ERC and also maintain full eligibility for full PPP forgiveness. Thank you. So with that, that's our kind of end of our webinar for the day. No doubt, I spoke to everyone maybe 5-6 weeks ago, and no doubt we may be having another webinar 5 to 6 weeks later as continuing guidance comes out from the government. We do our best to try to get insights out as quickly as possible, articles out as quickly as possible to our clients, letting them know as things develop. So I'd say just keep an eye on that, and then reach out to your local Eide Bailly professional to the extent that you have questions on either the reopening of the PPP1 program or the brand new PPP2 program. And with that, I hope everyone stays safe and talk to you soon.
All right, awesome. Thank you so much all for attending. Thank you, Adam. Have a great day, guys.